Hello, in this video we will be discussing about risks in investments. We quite well know how do we measure returns and understand returns very well. Now let's take an example, and with help of an example let's understand if that's all that we need to know. Let's start with one simple question. There are two stocks, R1 and G1, and you quite believe, and you have a report wherein it is quite expected that R1 will earn 35% per annum and G1 will give you a return of 20% per annum. Now the very simple question is, in which of these two stocks would you put your money? Here are few options to choose from. Would it be obviously R1 because of higher expected return, or would we consider G1 also because with higher expected return of R1 will also or may also come higher expected risk? Now this particular option B at this moment is a kind of speculative option, because frankly we don't know it, for it might turn out that G1 is actually more riskier than R1. We'll need to check out what the risk is in both of these things. Third, C, we always say that we need to diversify so as to minimize risk, so both of them. Or D, data insufficient, because obviously we do not know about risk. And the correct answer would be D, data insufficient, because in order to decide we would need to know the risks involved with both of these stocks. So let's understand what are the risks that we are talking about. Here are few examples of risk that a business faces. This is not a comprehensive list of risks that may apply to all businesses, but just few examples. Now, every business would face political risk depending upon where you operate, what are the regulations and rules, and changes that may happen in rules and regulation. If you have high debt on your books, interest rate risk may be something which is always bogging you down. If you have high cash on your books, this risk again still applies. Exchange rate risks, if you deal in multiple countries, if you have high amount of exports or imports, or if you have multiple offices in multiple countries, then this is a risk that obviously troubles you. Purchasing power risk, whether you do something or you don't do something, purchasing power risk, which can also be called as inflation risk, is something which is there for everybody as long as we are on this planet. Then we have credit risk, the risk of you not getting money that somebody owes you. Risk due to change in technology, especially applicable to firms and companies in technology sector. A new competitor on which you have had little control, and labor strike. These are few examples of investment risk. Now let's have a closer look at the right ones first. Political risk, interest rate, exchange, purchasing power. Do we really have control on any one of these? The answer to that is no. If we want to be in business, if we want to do something, these are the risks which we have to embrace. These risks come to us from within the system, and hence we call such risks as systematic risk. You don't take these risks, they are there just because you are there in the system. On the other hand, risk on this side are risks which are quite individualistic in nature. For example, you are betting big on a particular technology, but that technology does not pick up, all your investment in that particular technology goes waste. This is your individual problem. Similarly, somebody owing you money is not repaying, you should have been better or more careful about some things. Labor strike, you could have had better labor relations. So basically what we are saying is there are certain risks on which you have certain degree of control. You can minimize risk, or you may be taking risk willingly understanding the consequences, calculating the risk, right? So these are the risks which are not a part of the system and are called as unsystematic risks or non-systematic risk. So in brief, we can say that there are certain risks which by nature are there, system puts in, and we call them systematic risk. You have to take on these risks as long as you are there in the business. And unsystematic risks are the risks which are taken either willingly, or there are processes by which you can control this risk. Now, after going through this, let us bring back option number C of our first question. The option said invest in both, diversify in order to reduce the risk. What do you think? What risk is getting reduced by diversification? Is it the systematic risk, unsystematic risk, or both the risk? Well, systematic risk is a part of system. You can't really escape it. And how much soever you diversify, it won't really go away. So what really happens with diversification is your unsystematic risks get reduced, systematic risk remains quite as it is. Further, in order to decide where to invest, A or B, we will need to analyze the risks in both of them. And how do we do that? We can measure risk. How do we measure risk is something that we'll look at in the next video.